Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here's your host, Mike Alkin.
Welcome to the podcast. It is Tuesday, January 22nd, 2019. I am talking to you from downtown Vancouver as I am driving from Vancouver down to the Seattle-Tacoma airport so that I could get a flight back to New York. I just spent the last 3 or 4 days here in Vancouver where I spoke on a few panels and gave a presentation on uranium at the Vancouver Resource Investment Conference. And so it's about 7:15 in the morning, and it is dark as can be. So I'm navigating the streets of Vancouver as we speak, and my Waze keeps redoing it because I keep missing my turns. So anyway, came out here Saturday for the conference. Conference started Sunday, and the flights from New York to Vancouver, they just can't suck it up. They're later flights, and there's only a couple of them, and you got to take the red eye back. And after traveling 25 years doing this being in this business, I've given up on the red eyes when all possible. So what I tend to do is, or you got to take multiple stops, which I hate doing. So what I like to do when I travel, I like driving. I have no problem with that. So if I can get a direct flight to a bigger city and then drive a couple, 3 hours or whatever, I'm totally cool with that. I'd rather do that than sit in an airport. I could listen to some news. I could listen to a podcast. I could catch up on work and phone calls. So that's kind of how I like to do it. So I came out here Saturday night, but leading up to it was pretty wild because we had, all we kept hearing was, and like many of you in the rest of the country, we were going to get destroyed by snow. New York was going to get hammered. And of course, now we've had one snowstorm all year, and it's been a pretty mild winter. So, of course, the weekend I'm going to be away, it looks like the storm of the century. And so I get the snowblower ready. Everything's ready for my buddy who lives around the corner, and he'll come over. He'll do my house, and he'll do his own. He'll snow blow his own. And we do it, right? It's not like going up on a ladder. I'll still snow blow. We can, the landscapers, they have businesses where they come around and do that, but I kind of enjoy it, so it's not that big a deal. So anyway, but, leading up to it, now as I find, my kids are, they're great ages. They're almost 13 and 15, and I just love being around and being with them and hanging out with them and, their friends who come over. So I find myself more and more as I'm getting ready to go somewhere, I like doing the trips. Once I'm there, but the going is like but especially with the snow, right? I have my daughter saying, "Dad, I can't believe you're leaving us because it's going to snow, and what are you doing?" And my wife's like, "Yeah, don't worry about me. I'll handle it." And so every day the forecast is coming in. It's worse and worse and worse. Well, here we are. What is today? I don't even know. Tuesday? Nothing. They had zero. The inability, and I think it was Friday, they were calling for Saturday. It was going to be really bad. Literally nothing. A little bit of drizzle. And I can't get my head around the forecasting ability of the weather. It's been this way since I'm in my 50s, my early 50s. How is it possible? Actually, I'm a little bit older than that now, 54. But how is it possible at all that when I was a kid, they were bad forecasters, and today they're just as bad? With all the technology changes and everything, is it that complicated? But it just never ceases to amaze me. So anyway, we got through that relatively unscathed, and the weather out here in Vancouver is just great. I mean, in the wintertime, it could be dark and rainy, but it's mild. The temperatures are very mild, and got out here, and I love coming out to this part of the country. Well, it's not this country, the U.S., this part of the world. There's something just really, it's gorgeous. It's majestic. It's beautiful. And the people, the Canadian people, I find to be just incredibly friendly. I always look forward to coming up here. I mean, it's really enjoyable. And so, I don't know if you've all been to a resource conference before. I had never been to one that is more geared towards retail investors. My career has been spent going to institutional conferences. So I'll give you an example. Pick a firm. It doesn't matter. Morgan Stanley, Goldman Sachs, JP Morgan, whatever. There's all of them, right? They have investment conferences. And you go to these conferences and the companies come up and they present on stage, and you listen to their presentation, and you may or may not get a group meeting with them. You may or may not get a one-on-one meeting with them. And institutionally, kind of the way it works is whatever firm is hosting the conference, well, their bigger clients are going to get the better meetings. It's just kind of the way of the world. And if you're not an institutional client of Goldman Sachs, let's say, you're not going to get into that conference because you have to pay them. And you have to pay them big sums of commissions to become a client and to get there, right? So you often hear me talk about, the playing field is slanted, right? Well, that's one way that the playing field is slanted, because at a conference like that, a retail investor is not going to get in. Now, in the U.S., there's Regulation FD. So in theory, what a company is saying, they have to say in public. They can't advantage one investor group over the other. They can't tell, and in the old days, they used to do that, but they can't legally do that anymore. So they can't be in a small group meeting or a one-on-one and say, hey, Bob, this is what the quarter looks like. They can't do that. They'll go to jail for that, right? So it's not disadvantage in that way, because if they were to say our quarter is good, they need to tell the entire world that in a press release. So from that standpoint, it's not information that is, it's not information that they're giving, but if you get to know management teams and you get to see them occasionally, you get to watch them up on stage, you get to be in a group meeting or you meet them one-on-one, you tend to be able to read body language, get nuances, and so it helps to be there. It absolutely helps. It also helps to watch and listen, and are they consistent in their message, right? But if so that's helpful. And that's something that the average retail investor is not going to get access to. But again, they're not giving out information that is material and non-public. At least they shouldn't be. And I, going to these things for years, they don't. So conversely, a conference that I just spoke at, the Vancouver Resource Investment Conference, put on by Cambridge House. And up until a couple of years ago, I had never been to a retail investor conference. I had never spoken publicly about anything. I was a good soldier at a hedge fund for decades, an analyst, I became a portfolio manager, as a partner in the latter part of my career, and I just kept my head down and worked hard. And then over 2016, I think it was, late 2015, 2016, I really started diving into uranium work, and I was at home. And when I started to see the thesis and I started to believe strongly about it, one thing led to another, and I presented on Real Vision TV. Thing led to another, and I was invited to the Vancouver Resource Investment Conference. Apparently, some of the things I talked about uranium and the macro uranium, the picture, the macro, was somewhat of a different voice. And nobody knew who I was. I'm not a resource investor. I, over the years, occasionally would look into the resource industry for something. Maybe somebody would tell me an idea, but way more often than not, it would be on the short side, because a lot of my career was as a short seller. And I'm going to lead into the mining industry. But again, it was in an institutional context. So when I came to speak in June of 17 at the Vancouver Resource Investment Conference, and I opened I went into the hall, I hadn't ever seen anything like before. But at the Consumer Electronics Show, consumer trade shows, where they were more industry trade shows where companies had booths and they had samples of stuff. You go to the houseware show in Chicago and they have cutlery and they have every gadget you could think of. Here, it was booths with all mining companies of all sides, mostly junior miners, very, very small junior miners, with booths and management teams standing there and telling their story to retail investors. And when I first saw that, I thought, okay, not sure what I think of this. It kind of feels like a trade show. And again, you know what you know, right? So for 20 plus years, that's not what I knew. And so I was trying to get my head around it. Mammoth Hall. And the people at Cambridge House are wonderful. They can't be more accommodating. Really, really nice people. And so for me, this was my adjustment, not them. This is what they do, and this is what the industry of junior mining is. And because they don't get the coverage from the bulge bracket, the big firms that have these institutional conferences. There are a few brokerage firms out there that do it, and they have conferences that will let some retail people in. But those are smaller firms. I'm talking the bigger institutionals, where the JP Morgans, the Goldman Sachs, where the bigger companies are. And so, when I first got there in June of 2017, I was walking around the conference hall and I was going to speak publicly about uranium. And like I said, I'd never spoken publicly. I'm an introvert. I don't like standing in front of a group of people. I'm not chatty. On the podcast, you might say I ramble in the monologue, or when I'm talking to that's just because I'm excited about the topic. But I can't see the 35,000 people a week this gets emailed to, and notified of the podcast, and the 8 to 10,000 people that are going to listen to it. I'm just either sitting in the room I'm recording it, or I'm driving right now and I'm talking. But standing in front of a group of people with hundreds of people was new to me. So that first time I'm there, now I know the subject matter inside and out, so I'm fine with that. But little silly things like, how do I get up on stage? I don't know how to use the clicker. I could barely use the TV clicker at home. I am somewhat of a technology neophyte. So I'm thinking, okay, I've got to get up there. And I stand up on the podium, and of course I have no idea what I'm doing. There's two buttons, red and green. Red, move your presentation forward. Green, move it. Green, move it forward. Red, move it back. Of course I couldn't figure that out. And I'm pointing at it all over the place. And then whenever I went to presentations, I always saw people looking down in front of them, because they would be their presentation would be on the screen behind them, but they were talking to their presentation, which was on the floor on a big monitor in front of them, so that they could follow along. Because you do a 20, 25 page deck, you don't remember order, sequence, or some people do, but most people don't. They need that guide to be reminded what they're showing people looking at the screen behind them. Didn't have that. So I had to keep looking back on the screen. Well, it turned out okay, because at the end of the conference, or the presentation, in the next hour, let's say, I'm walking around and I had lots of people coming up to me saying, hey, that's pretty interesting. Wasn't aware of this, that, this, or that. And one of the things I've learned about the retail investing crowd in resources is they've been, many of them, not all, but many of them, at least that I've met there, management team. They follow the stories. And so they follow what's going on. And so I brought up some topics that people hadn't been really thinking about. And so that was great. And that eventually went on YouTube, and it went all over. And I had management teams of uranium companies calling me, wanting to talk to me about my macro view. And one thing led to another. Here we are a couple of years later, and I have a uranium-based investment vehicle. So, but that's not the point of all this. So I've gone back. I've been invited back a couple of times. One time I couldn't get back. I hurt a shoulder playing hockey. But as I've gone, and I'm less, not overwhelmed, but less amazed at the theme and the setting, and forgetting I'm not at a trade show, I now am more adept at walking around and listening to the company's messages, and they have workshops. So these workshops there's about 6 workshop rooms where presenters go in and speak, and they have some panels and they have stuff like that, and it's from all walks and shapes of life. There are newsletter writers, there are companies, there are industry thought people, and one of the things you realize so you can go in and sit wherever you want, but as you walk around, I'm guessing there's hundreds of companies. It's got to be. I'm guessing, but and as you walk around and you talk to people at the booths, what you realize is everyone has a great project. Everyone is on the exploration side is really close. They're a long trend on strike, right by trend. They're going to really, they're close. They're going to get it. They think. They're pretty sure. They're going to show you the presentation and why they're there. And you're like, wow, it's pretty amazing. Look at all these companies that are really close to making it happen. And then you realize that something like 1 out of every 5,000 holes drilled really turns into any discovery of any kind. So either you have a really lot of optimistic people there, or people who truly believe what they're saying. And I tend to think, I'd like to think some do. Many do. Some do. Maybe. But when you really start to unwrap it, you say, okay, well, so what is this? Well, it's a group of junior mining companies across all different commodities, right? So it's, you name it, they're there. And at the end of the day, I like to say that junior mining companies are almost like biotech companies in a sense, that biotech companies, discovery stage companies, really are in business to do research and development. And they don't generate revenue. They're trying to find the new thing. And what do? They are exceptional at raising capital. Exceptional at it. They raise money. That's what they do. Why? Because that keeps them in business to do research and development. How many drug discoveries do they have? Not a lot. But they serve as almost the R&D arm of some of these big pharmaceutical companies, because they eventually, if they find something, they get bought. Kind of similar to the junior mining industry. Their R&D is exploration. Their R&D is development, right? So early stage is exploration, and then you get into, we find something and we have to develop something. And then from there, you build a mine, and that requires capital. But at each stage, there's a little bit more and more certainty. None of it's easy, but you're there. So, but the riskiest is in the exploration stage. And if I think about one of the regions of the world that, let's use uranium, has a lot of uranium, there's in the Athabasca Basin, the highest grade uranium jurisdiction in the world. In the last decade, you've had 4 major discoveries. And if you look at those companies, they've spent on average $17 million in the exploration stage and $33 million in the development stage. So $50 million. Well, that's often much bigger than the market caps of those companies at the time. So, but they found stuff, and some of them, they found great big deposits. But that needs to be financed. So if what you need to spend is more than the entire worth of your company and what the market is paying for it, you're going to have to raise money, and there's going to be dilution, and that's part of the business. That is a known. But when you have history of success of exploration is very low, that means there's a lot of companies out there that are telling you and showing you a good story, because none of them would be doing it. Well, I shouldn't say that. There are some that are completely full of shit, know they have nothing, and they're bad guys and they raise money. And that happens. That absolutely 100% happens. Most aren't bad guys. Most believe they have something. But a lot of them aren't going to work. And so as I walk around and I look at this, and I think it's a wonderful venue that Cambridge House has put up. I think it's a very low cost to get into it. But you get access to companies and stories and management teams that you might not otherwise have access to, and it's a good venue for it. That's the pluses. The other side of it is, in the world of exploration, let's say, and development, unless somebody is a mining engineer or geologist or has real intimacy with the nuances of this, you can hear a good story that's nothing more than a good story. And the stories tend to get better when companies are in the needing capital raise. Right? They tend to always need news flow. And so, unless you have someone to access, to opine on it, I have geologists that I can go to. I can speak to mining engineers to say, does this make sense? I'm neither. I'm not a mining engineer. I'm not a geologist. Fortunately, over my career and earlier in my career, being a generalist investor and looking at virtually every industry on the planet, there are some that resonate more than others. There are some that naturally you can analyze more natural than others. And everyone's different. There are some more interesting than others, some less interesting. But I realized early on as a generalist that there are some things, for me, I'm good at, some things I'm not. And what I also learned is you trial by fire and mistakes. And so I kind of whittled down what I could kind of understand and can't understand. And I know in the world of uranium, I've studied the basics of the geological formations. How does that prepare me to invest in a uranium company without other insights from others who know it? Not great. Right? I have to have built a network and talk to people and understand it and understand the history of these formations. And so that puts me at a research level that I can really understand. And same thing with the mining engineering. And does this work? And you talk to people and you get to know them in the industry, guys who've been doing it forever. Does this make sense? Does that make sense? No. Here's why. Great. Now, if you're at home and you're investing on your own, you may not have the time or the access to people like that to do it. So I have learned what I know, what I don't know. And I'm very happy to admit that. But people who are walking around this floor, and it's interesting because now with this podcast and, when I walked around in June of 17, nobody knew who I was. Now I walk around it and it was kind of funny. I was telling my wife and kids last night, I said, I got people coming up asking to take selfies with me, and they laughed. They're like, you? Why? And I'm like, I don't know. Because they hear my voice. You hear my voice, and I love that people come up and say hello. I'm not worthy of a selfie, I promise you that. But it was funny. But I talk to people at the show, and people come up and we talk, and and I could tell the investment acumen level of certain people versus others. And it's really great because people from all walks of life will come up and talk to me, and my God, they're getting up to speed. A lot of them are learning and trying to get up to speed. And they'll ask me, what do you think of this? What do you think of that? And I don't talk about, I don't talk about the individual companies. And if somebody says something about something that I think is really just wrong, I message it that you might want to rethink that or look into that or something like that. But I could see that you have really well-intentioned people putting really hard-earned money to work, and that they're trusting what they're hearing. Then, I write a newsletter. So I do two things, right? I have my business, the firm that invests in uranium funds through a vehicle. And I write a newsletter about short selling, which is expressed through puts at Curzio Research. So once a month I come out with an idea, and I'll update as I think is necessary. Less is more. That's my view. There's too much noise, but that's my view. And a couple of years ago, I knew nothing, zero, about the newsletter business. I read maybe Jim Grant's Interest Rate Observer. I read Fred Hickey's High Tech Strategist. But I didn't know the larger newsletter industry at all. And I met Frank Curzio, super nice guy. When I first started talking about uranium, somebody suggested I should write a report about it. So I did, and I put up a website. And after a couple of months, I realized, you got to deal with credit card issues and all this other stuff and billing. I was like, I have no interest in that. I met Frank, and Frank said, hey, you should write. Well, you're a short seller. I said, yeah. He said, there's not a lot of short expertise in the market. You should write an investing letter about short selling, educate people on short selling. So that's interesting. And as I was just talking about, right, here I am at a conference. I see a lot of companies. I'm like, oh God, I don't know how many of these are going to come to fruition. So what am I looking at? What do I look for? And I thought, well, that'd be a really cool way to educate people. And so a year or so ago, Frank published the newsletter for me called Money Flow Trader, and it educates people about short ideas. But Frank and I said, I can't tell people to short stock outright because it's hard. It's a real art. I mean, the fundamentals you got to get right, but in short selling there is unlimited risk. Now I did that my whole career, and I could sleep like a baby when I was short something going against me, losing money, because I felt the story. I knew you do it, right? Whatever you do for a living, whatever it is you do, you have good days and bad days, good weeks and bad weeks. If you have a good foundation, you understand how ultimately you think it's going to come out, you sleep okay, right? There are times where you sleep less okay. There are times where you're like, oh shit, I'm wrong. And you learn, okay, I'm wrong, I'm out. Take your mistake and move on. There's one thing I could tell you about investing is no matter how good you are, you're going to be wrong. You're going to be spectacularly wrong sometimes. And the best thing to do is own it. I was wrong. It's a really cathartic thing to say. Because I could have the fundamentals correct, my thesis could be right, and something came out of left field in any industry over my career. Some of my best ideas on the short side were, as a short seller, you're usually very early. You're spectacularly early because you're seeing things in the numbers or seeing things in the industry that are not yet reflected in the stock price. And it takes a while. Most analysts writing about the companies at the bulge bracket or at the sell side firms, they're positive. The companies are always positive. Can't remember the last time I stood up. I went to a conference or spoke to a CEO, and he said, I've been born salesman. and you don't get to the C-suite, CEO, CFO level of companies by not being a good communicator and not knowing how to play politics and not knowing how to message and not being really, really shrewd. So when we decided to do it, I said, we can't really do short selling because I could be early, a stock's up a lot, and it could get taken out, or it could be a momentum stock and people get run over, even though I'm right on the fundamentals. We said, let's do it through long-term puts, which is an option strategy. And you buy a put and here's the expiration date. And if the stock goes down below the strike price, you'll make money. If the stock is above the strike price or at the strike price at expiration, you're going to lose the whole investment. But let me educate people as to it should be a very small portion of your portfolio. Here are some ideas, but I'm not going to give you some ideas, good ideas, but I'm going to educate you along the way on how to think about analyzing a company and what I'm looking at. And through that, it's going to help you in other aspects of your investment. So I really like that. Got to know Frank, really, really nice guy. We're from, oddly, we graduated from the same tiny college in Long Island. Didn't know each other then. He's a Queens guy from New York. I'm a Long Island guy. So if you're not familiar with geography, Queens is a borough of New York City. Long Island is a little bit further to the east. Frank has a much thicker New York accent than I have. I don't do the accent thing. Frank's got a much thicker accent. I lost mine many years ago. I say that jokingly, but Frank's Queens are tougher guys, and Long Island guys are a little bit softer. But we had that in common, and as I started talking to Frank, he worked for 20 plus years in the newsletter industry, and at one time he worked for Jim Cramer at TheStreet.com. He wrote a lot of his stuff, newsletter. He did a lot of podcasts every day, and I started listening to Frank's podcast, and I thought I really like his messaging. I think he understands what he's talking about, and he's smart. And again, I didn't know the newsletter industry, so Frank said, "Okay, let's do this." And I said, "Great." And as I've done, it's been a year now, I think, and the newsletter was up last year, not spectacularly, because it's not up market, down market. It is not. Hey, I don't make market calls, right? I risk on, risk off. I think there's more risk in the market than not. Here's why, and I've reduced exposure and this and that. But these are individual companies, and some have worked beautifully. A couple I've just gotten flat out dead wrong, right? So a little mixture of everything. And I'm learning. I can't write my newsletter like I analyze a company, or if I was sitting around at my fund now and talking to my analyst or my prior firm with my partners. There's no backstories. When you're writing a newsletter to a retail audience, you've got to engage people and tell them the story of the company and the history of the company and keep people interested. I can't put pages of financial analysis down because I'll lose people, and most people are subscribing to learn, and I can educate them, but not I can give the end results of my analysis, but I can't put spreadsheets and heavy financial analysis in the newsletter. I can talk about the outcomes of that. So, and as I've gotten to know Frank, I really like him. He's a very, very genuine, nice guy. And like all of us, I have my good picks and bad picks. He has his good picks and bad picks. And I can tell you when he has a bad pick, he's nauseous, just like I am, right? If I made a mistake or my timing was wrong or I misread the art of what it is, and when I say a mistake, meaning I wasn't sure that the management team would be this promotional, and I missed that part of the art of it. You feel terrible. But again, you're going to be wrong. You accept it. You go on. You try to always minimize your mistakes. And Frank is the same way. What I've learned, though, about the last year of the newsletter industry, because like anything, you do something new, you want to understand it. So I started looking at different newsletters and paying attention. I didn't even know they existed a year ago. It's nauseating. I don't know that the old time newsletter writers would probably be mortified at what you see out there. Everyone was a Wall Street trader. That's the term, right? Trader. Really? Okay. I was a partner at a $4 billion firm. Again, it doesn't mean I'm right a lot, but you got to know who these people are. What did they do? What was their role? Were they a sales trader executing orders for the portfolio manager? Were they a Wall Street financial advisor, not having discretion over people's money? It's important to understand, right? So there's a lot of jargon. And then what I learned is it's about, they sell greed and fear. When the market's going up, what is hot? And then go write a package about that and find stocks that are working and tell you how much gains you can have. And then when the market is going down, let's throw fear in your face and tell you what you should be doing and sell subscriptions about that. That's the industry. It's clear to me, the industry. I find it repulsive. And Frank will tell you, we joke a lot, right? Because you're in the business, you need subscribers, but how do you message it? Because you can, for me, you should be doing the opposite than what the crowd is doing. But the buyers of newsletters, that's what they want. They want what's working, what's hot, what they can tell their friends about. It's wrong. But that's what sells. So you have to find that nuanced message. So I've learned about all this, how to message. And in my newsletter, I talk about in December when the market was down, 10, 12% in December. It's been down 20. It was down 20 from the peak. I didn't send an update about what you should be doing today. I've been talking about it for the last year. On the podcast, you've been hearing me say about it. But on CNBC and everywhere else, they were pounding the table. This is what you need to be doing. The market's imploding. Right? From the last week of December, the market has gone parabolic and straight up. That's all it's done. Right? Wayne Gretzky skates where the puck is going, not where it's been. So anyway, my point is, at this conference, you get to see it all. You get to see the companies out there pitching their stories. You get to see some newsletter writers standing up there. And I don't know a lot about a lot of things. I have looked at a lot of industries. I have a good foundation on analyzing companies. In the resource space, I don't know resources. I know uranium. And I know the macro uranium story really well. It doesn't mean I'm right. I think I'm right. I think today I'm more right than I've ever been, but it doesn't mean I'm going to be right. But my conviction level is as high as I can possibly say it. And as I spoke at the conference on Sunday, the very last words I said were, when I was here in June of 17, and I had walked them through the presentation of what I said, today I'm doubling down, and I have more conviction than I ever had. And since then, by the way, the price of uranium when I spoke in June of 17 is up 44%, and the equities have kind of not got there yet. But from a fundamental standpoint, I can't feel better. But I know that the thousands and thousands and thousands of hours that I have put into understanding the nuclear fuel cycle and modeling it out, the different stages of the fuel cycle and the inventories and the reactors and the mines. I know that. That is not what most newsletter writers do. Many of them are gifted writers. I am a terrible writer. I have editors who help me. They help me. I tell them what I'm thinking. They put a backstory to it. And then I write my stuff. And thank God for Ashley at Curzio, who edits my stuff and can take my financial gobbledygook and put it in a way that people are going to understand it. But I sit there And I listened to some of these presentations, and it's all I could do to keep my mouth shut. Because one of the things I want to impress upon you is accountability. It is very easy to stand up in front of an audience of people and tell people, as I said, and as I've done, and as I predicted, and as I did this. And 25 years ago, you had no way to check that. Here you do. Now you do. We live in a world where you can check anything. When I, 3 years ago, started to sniff uranium out, well, my God, YouTube was my best friend. So one of the wonderful things is, right, I lived on YouTube. Let me go back and see what people are saying and about uranium. And I went to 2012 and 13 and 14 and 15 and watched presentation after presentation after presentation. And I took my notes and I did my stuff. And then as I started to peel the onion back and did my own work, and I started to look at the import of the devaluation of 90% of the Kazakh currency and the benefit it had to Kazatomprom, the state-owned uranium producer, which is the biggest in the world. They cost in tenge and sell in dollars, so their cost structure was low. Their dollars went up, $90, and that helped their margins in a really big downturn. And it helped their cost structure. I don't know how that is. Look at that. They're spending a lot less on capital expenditures. And that's going to catch up to them because of the mining method they use, right? And I didn't know that right away. I started piecing that together. And then I started looking at the impact of secondary supply on the market and the underfeeding is occurring, which I'm not going to get into a detailed discussion, but a very, very important aspect of it. And I started to look at all the bull cases, and I thought, holy cow. So my apologies if I just broke up a little bit. I'm in a little bit of a desolate area on the way to Seattle. So, I put in these thousands of hours understanding the fuel cycle and modeling out the reactors and the mines and all of this. And when I talk to people, I can tell what level of knowledge they have. Now, again, I want to emphasize something. I am not a uranium expert, as I get called. I am not. I'm a guy who understands capital markets. I'm a guy who understands from doing it for a full career supply and demand and the impact on markets. I'm a guy who just my habit, the style of investing is contrarian, right? That's a term that's often used flippantly or too often. And all it basically means is I'm looking for changes in data in industries that are either too high, when I say too high, that have had extremely strong moves to the upside or extremely strong moves to the downside. And when that happens, it attracts crowds. It attracts money flows. Money Flow Trader, the name of my newsletter. It attracts interest. When you go out and you're at your friend's house, you're talking about, people talk about what's working, what they own, why they like it. I own this one. I make this much money on it. They don't like to talk about, hey, I got this stock that's in the toilet, but I think it's going to do it. But you know what? When everyone's doing something, it becomes a greater fool theory, right? Who's going to be the one to sell it to the next guy when valuations don't make sense and you never short a stock on valuation? Or you don't buy a stock because it's cheap. What you do is when you have crowds, behavioral psychology is so impactful to the markets and how stock prices ultimately do, right? If you own Bitcoin at 18,000 because everyone else did, it's 3,500 today, less than about a year later. I have no opinion on it, but it is kind of right. When it goes, it goes. So what I like to do, my style of investing, is looking for those extremes, looking for where the narrative is so powerful in one direction that either people aren't looking at the subtle or less than subtle changes taking place, or their disbelieving of the subtle or less than subtle changes that are taking place. Either could be happening. But when there's a huge swell of sentiment in one direction, my experience and how I've made my living over the last 20 plus years is I'm looking to see if I can poke holes in it. Because when it swings, it can swing hard. And again, I've not always gotten it right. I'm not always going to get it right, but that's how I approach investing. And I bring a framework to it, an investing framework, both qualitatively, which is called the art of investing, and analytically, which is understanding financial analysis. If you follow me on Twitter, I'm called Footnotes First, at Footnotes First. Why? Because that's where the good stuff is. That's where the details are in the filings that companies make. And oftentimes, it's boring, it's dry, it's complicated, but that's what matters. That's where the good stuff is. So back to uranium, I could kind of tell after doing this. So I say I'm not a uranium expert. In the world of macro uranium, understanding the moving parts of the uranium cycle, I'm pretty good. And again, I hope you know me well enough to know I don't blow smoke up my own ass. I don't blow smoke up your ass. I get things wrong plenty. I own them when I get it wrong. In the uranium macro, I kind of think I understand what I'm talking about. Now, I will tell you, one of the hardest things to do in investing is getting a commodity cycle right. It's forecasting the price of a commodity. I don't know where the price of uranium is going. I think I know where the price of uranium needs to go to meet the demand that's out there. And that's north of 50, and it's 29 today. And I think it has catalysts to get there because there's a contract waterfall expiring for utilities that need to come into the market. And I think the timing is around now because of the length of the fuel cycle and how long it takes to order this stuff. And I could go on and on and on. But what I've done over the last 3 years is really understand this stuff. And what has surprised me beyond anything I think I've ever done in my career is, with the exception of a handful, and I mean a handful, the executives in the uranium mining space don't really know the macro. They may know how to finance companies. They may know how to raise capital for companies. They may know how to explore. They may be a geologist. They may be a mining engineer. But they've all relied on the same data that everyone else has used, coming from a couple of firms and a governing body. And I'm not going to get into the discussion as to why I think those numbers are inaccurate for many reasons. But for so many years, they've been untested because there has been oversupply. And everyone just kind of thinks, whether it's the physical traders, the brokers, the physical traders of the commodity, the brokers, the buyers of the commodity. Remember, the buyers, it's a very small portion of the cost. I don't care what anyone says. Right here in the U.S., there's the Section 232, where the two miners are petitioning the government on the grounds of national security to make the fuel buyers in the U.S. buy more uranium from 25% of their uranium versus the 1% or 2% they buy now from U.S. miners. And they're jumping up and down saying, you don't understand that the industry in the U.S. is a mess and we could go out of business. Now, these fuel buyers are really smart people, right? Good people. I've met many of them. Very smart, very nice. And it's their job to buy fuel and do a lot of other things. But I'm a simple person, and to me, it's all about math. And when I could look at what the actual input of uranium is to a nuclear reactor, the cost, and I could look at history, and I could look at buying behavior and buying patterns, I don't think it matters that much. So I could be wrong on that, right?
I think it's about 5% of the overall cost of operating a reactor. It can be 3 to 5 to 6, maybe 8. Well, in half the states in the United States, they're regulated utilities. They go to the Public Utility Commission, they get a rate hike. In the other half, they're struggling, right, because natural gas is low. And the world thinks that natural gas will stay at $3 forever. It won't, but it thinks that for now. And that's so now natural gas is more competitive, and it puts some of these reactors at risk. And I'm not going to get into the nuclear power story, but you're seeing in states around the country, you're starting to see the states come out and support the nuclear. It's clean, it's base load, it's big. But this isn't a discussion about that. But I can look at the actual costs, and in my analysis, I say, well, they're going to pay whatever they pay if they need it. And I don't think it makes that big a deal. And oh, by the way, we went and looked at the last 30 conference calls of publicly traded electric utilities that have nuclear power in the mix. And when you're a company that has a business that could be potentially under threat from a government action, and you're the senior management of that team, you're going to reference that on a conference call with investors, on an earnings call, and you're going to signal it in your filings. And the analysts following the company are going to be asking a lot of questions on it. Well, we've gone through 30 of those over the last 3 quarters since this action has been taken. One company, has made 2-sentence mention of it. One company, a couple of sentences, no analyst asking questions on it. Why? Because I think it's not that material. To those people buying it, their budgets and all that, yes, it's meaningful. To the overall operation, I don't think it matters. I could be wrong, but that's my view. And I've studied a lot of the history of that and understanding, looking at inventory levels, looking at purchasing, and that's my conclusion. But the whole point of this is it comes from a place of a lot of research. I can tell when I'm talking to people who's a good talker. I can tell who really has knowledge of it. And like I was saying, I've been dumbfounded. The industry's been in such a bear market. A couple of people put numbers out there on it. The sell-side analysts, with the exception of one now that I've seen, that I've been impressed, they all follow the numbers of these organizations. And that's it. That's the Bible. Meanwhile, the things I was talking about at the conference in June of 17, impacting the market, and as I look at it, it's changing dramatically, right underneath the noses. That's how I made my living for the last couple of decades, looking for stuff like that. Again, am I right? I think so. History will tell, right? Time will tell, and we'll look back. But what I do have is timestamps. YouTube, you'll see me all over on uranium, right? And you should look at what I said in June of 17. And you should look at what I say if I'm interviewed somewhere. And you should look at what I said when it comes out the next week or two at the Vancouver Resource Conference. And you should hold me accountable to that. And if a year from now, something occurred and I said, as I said, go back and look to see if I said it. Because I saw a lot of that at this conference. And I think it's bullshit. And I think that you need to understand in this environment, understand what companies are saying, understand what the people telling you, the so-called experts. I hate the word expert. And go back and just take time. Go back and look. Did they really say that? Is that a right call, or are they owning something now? Whomever it may be. And hold me to that standard as well. So as I'm walking around and I'm talking to people, I don't know them from Adam. I get approached. I can't walk through the conference room now. It's ridiculous. I say ridiculous in a good way. It's funny because I'm a nobody. I'm a hedge fund guy for a long time. I rose through the ranks. I had a good job. But I'm a regular guy who happens to understand a little bit about investing. And so people coming up to me, but I can't walk through the conference floor without every stopping me for 10 or 15 minutes and want to talk about uranium. But as I put a mosaic of information about the uranium industry together over the 3 years, I'm pretty quick study. I'm very good at very few things. Math, analytics, pattern recognition is probably my best strength, and that's a good thing to have in investing. But one of the patterns I would pick out very quickly is how people will tell me why they like a company and what the management said. Now, after 3 years of analyzing these companies, talking to them countless times, and when I talk to them, I ask them the same questions over and over. And I know the answers to them. I want to see how they answer them. Because if somebody's lying to you or being a little loose with the truth, they might not remember always what they said, but I write it down. And so I like to test and test and test. And the more I get to know a company, the more I'm invested in them, the tougher my questions are. The more I hold their feet to the fire, and the bigger the position is, I do. And so it got me to thinking. I met a guy, really, really nice guy, talking and was telling me, and obviously he was knowledgeable about some of the companies, but he was knowledgeable about what the companies were telling him, which is great. So he's obviously walking around with a notebook, done his work, and that's fabulous. But if you're focusing on the wrong stuff, it doesn't matter how much you know. So when you're looking at these companies, right, you want to understand if you're looking at an exploration company. So you got to spend a lot of money to go out there and build or explore for this stuff. Substitute uranium for anything about it. How do you decide what your targets are? The guys that are drilling for it, have they done this before? Have they done it in the same commodity? Have they done it in the same jurisdiction? What kind of success have they had in doing this in the past? Have they gone from job to job to job? Have they done it? Have they been there? Have they succeeded at it? So now tell me how you're going to find this. How are you going to finance this? What's it going to cost you? And does that square with what other companies are paying per hole? What's the timeline? When do you want to do it? Does the market come into play? If you need to raise capital to do it, is the market just on its head? If you sit there and not do nothing and burn less cash, would that be the wise thing to do or not? How are you going to allocate it to what on this project? Tell me why you're spending money here. Why are you drilling here and not there? Explain it to me. Again, not being a geologist, right? I'm going to go back and talk to people. Or people who know the area. If you have the time and inclination to do that, you can do that. But ask them these questions. How are you going to raise the money? How many times have you raised money in the past? How dilute this been? Oh, you want to go out and buy another project, I see. Why do you want to buy that project? You have a few already. Oh, so you want to buy this project because you're adding pounds. One of the things in valuing resource companies in the uranium space, people look at it, boy, it's really cheap on an enterprise value per pound in the ground. Look at that, it's trading at X. And the group trades at Y. It's a big discount. It's cheap. Go back and look and see over how many years, how many acquisitions this company did. Because it's very easy to increase your pounds. You go buy it, you issue stock, you dilute your shareholders, potentially. But you might have bought crappy projects that other people wanted to sell, but you bought X millions worth of pounds. And now you got more relevancy. on the surface is you can stand up at a booth and say, oh, we got X millions of pounds. We're pretty big. Well, that's great. If those pounds will never economically come out of the ground, it's meaningless. And that's why enterprise value, market cap, I got cash, enterprise value, divided by the pounds of the ground gives you a number, right? So the more pounds that you have, it's going to bring your number down. It's going to bring your valuation down. But they could be total bullshit pounds. Where is the project? Who sold you the project? Why did they sell you the project? What was appealing about the project? I'm not going to go on to the whole thing, but you got to ask these questions. Tell me about your cash burn. You're burning this amount of cash. Why are your peers burning less or more? How are you thinking about hiring? How are you thinking about laying people off? How do you feel about skipping a drill program because it's not the right time to do it? It's going to cost too much money now, and the fundraising environment isn't there. Right? I mean, there's countless number of things you can start to be thinking about in terms of this. Oh, you're going to, all of a sudden your costs lower dramatically or increased a little bit. Why? Explain it to me. I don't understand. Tell me. Walk me through it. Give me the details on that. Don't give me the headline. I see on this page it says this, your cost did this. Walk me through how you did that. Why didn't you recognize that before? What changed? Did you hire someone new that told you about it? Or did you realize that you have to have a lower cost story for it and you found the costs? How? Does it make sense? Did you sacrifice something else? So, and again, go back and look at what historically they've done. Go back and look at the share count of these companies. Have they been doing acquisitions? Did they acquire X millions of pounds? And look to see a couple of years later, did they do further drilling? Did they increase the category? Did it go from inferred into indicated or measured and indicated? Did they uncover more pounds? What did they pay per pound at the acquisition price? And now how many pounds do they have? And did they accrete value? Or have they been issuing stock constantly for general and corporate purposes and not coming up with anything? If you look at some of these companies over the years, they've diluted their shareholders 2x, 3x, 4x, 5x. I mean, it's crazy. Not all, but some. Many have diluted, but at different degrees. And when you're in a bear market, you got to dilute, right? If you're to some degree, but you want those guys who are really good stewards of capital. So my point is of all of this is, I started out by talking about the institutional environment and the conferences you go to, and how the retail investor doesn't go to those. And then here's a setup where Cambridge House puts on a really nice show where a bunch of people can go and talk and learn. And it's fabulous. It's a great venue. They do a wonderful job. They're very nice people, very accommodating. That's been my experience with them. But now once you're in that room and you're in that hall and you're talking to really polished people who are telling you their story, you have to have some tools in your toolbox to understand whether or not story makes sense. I was talking to my friend Jamie Keach at Resource Insider yesterday, and he gave a presentation. I didn't see it, so I'm going off based on what he said. You know, what percentage of companies here, Jamie's a mining engineer, what percentage of companies here, probably the story is different than what you're actually hearing. That's a big number. It's more than 50%. I'm not saying they're lying. It's saying that they're telling you, but they're showing you the good stuff, or the best part of the story. Right? So some may be lying. I am a professional short seller. That is how I was raised in the industry. My DNA is to come at almost all companies very distrusting. I think they're bad guys, but it's trust but verify would be a real stretch. But I don't trust what they're telling me until I can go verify it. Right? So I am coming in, I'm skeptical. I'm not buying the story. You're going to tell me the story. Then I'm going to go back and try and see if the story makes sense. And that's my working model. You can call me cynical, guilty as charged. You can call me skeptical, guilty as charged. You can call me a prick. Not personally, I'm not, but professionally, I'm not going to give you the benefit of the doubt until you've proven to me. Just like you shouldn't give me the benefit of the doubt. Half the people who came up to me the last 2 days say, I know you don't talk publicly about what stocks. You're like, what should I buy? Like I said, I don't talk about that. If you ask me a question about a company and I think you're really wrong, I'll steer you in the right direction. If you've asked me a company, do I think this company's doing good things, I might tell you, yeah, that's interesting. Or I might say, that's particularly cheap in my view. And yeah, I think that's reasonable. But I'm not going to get into a thesis. I'm not going to lay it out. I'm not going to talk details. But I think you need to have a framework for doing this. And my framework is hear the story, go back and listen to it, go and find people to help me understand some of the things I might not understand, marry it to the macro. And getting back to the macro, as I talked about before, it's staggering to me. The lack of depth on the macro. And as the macro is changing, you'll see people adopt that theme or thesis or bullet points. Go back and look at June of 17 when I talked about it. Go back and look at other people's work from 13, 14, 15. See if it's consistent. Whomever it is. Don't, and I tell people when I talk to them in the hall, don't listen to you on this podcast, my listeners. Do your own work. I'll try and point you, give you my view, try to point you in the right direction. But you've got to have some sort of framework. Otherwise, you're just along with the herd. And again, you're going to do the framework. You're going to develop a framework. You're going to do the work. And sometimes it just doesn't go your way. Shit happens. Sometimes you miss something. Sometimes there's nothing you could have thought about. Stuff happens out of left field. It happens. Right? That's why you don't put too much of your portfolio in any one thing. But it did. I just wanted to talk about it. I'm not going to have a guest. I'm driving down from Vancouver to Seattle right now. Of course, it's raining. But I wanted to share my thoughts on the conference. I'm not going to tell you what companies I liked or didn't like. Do your own work on that. But remember when you're looking at these companies, remember these junior miners are in the business of many of them exploration, some development, some few of them production. But it's a money grab. They're looking to raise capital. Most of them. Not all, but most. And you don't raise capital, you don't have a story to tell. You gotta have a story to tell. So it's your job to any industry. I'm talking about natural resources now. Any industry. So anyway, that's my 2 cents from the Pacific Northwest. I just got yelled at by the border customs guy. Apparently, I pulled too close to the car in front of me, and I got yelled at because I didn't see the sign that said stop. And what if you had a guy out in front? I'm like, okay. Just like coming across the border, I got to ask 50 questions as to do I have the letter of the conference I'm going to? Here, I got a briefcase and a small suitcase. I'm going to speak there. What else can I tell you? You let me go. But anyway, that's my story. Hope you have a good week. I didn't even know I was laughing. I didn't know today was Monday or Tuesday. When you're at these conferences, you're inside all day. There's no windows. You just got to get a little disoriented. You go have a couple of beers afterwards. And, now I'm just looking forward to getting back home on the 5-hour flight, 6-hour flight, get in about 9:30, go home, kiss my wife and kids, and catch up on what I missed in the world of the NHL. Oh, by the way, before I let everyone go, we're going into the All-Star break, NHL. If you open the paper or go to ESPN or NHL.com, just click on standings. Click, you know how to click. Look at the Metropolitan Division, and you'll see the New York Islanders in first place. I'm just pointing that out. I will be opening up bandwagon seats for those who want to jump on board the bandwagon. I know it's a long season. We're halfway through. If you look at the point standings, what separates the 8th place team take Tampa Bay out of the mix is dominating, but numbers 2 to 8, a couple of games out of the way. But I am going to relish every moment until the Islanders are out of the playoffs, if that happens. It's been so long. I am like a kid in the candy store. I check the standings 17 times a day just to make sure that they're still in first place, even when the games aren't playing. Anyway, hope you have a good week. I will be back next week with a guest, and we'll go from there. Thanks. Take care.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.